Good afternoon, you're watching BloombergQuint Live. I'm Alex Matthew. Here are the headlines. Indian markets set new records with PSU banks leading the rally. State-owned banks add more than 75,000 crore rupees to their market cap in the first 3 hours of trade as investors cheer the government's bank recapitalization plan. The RBI governor welcomes the move. Reliance Communications decides to pull the plug on its wireless business, will transfer some of its high-value customers to the enterprise vertical. HCL Technologies meets estimates in the second quarter. The management also sticks to its FY18 constant currency guidance. The country's largest reinsurer makes a tepid debut on Dalal Street, lists at a discount to the issue price of 912 rupees per share. Now, we're going straight to Ira Dugal, who has an update from the RBI. The RBI statement has just come in with the statement from the RBI governor. Ira, over to you.
Alex, thanks so much for that. Apart from the customary statements welcoming the package, etc., and I'm going to skip through all of that because, that is a given. Just getting to some of the specifics that they talk about, they say that, they actually think that this particular package, the way it's structured, is a good idea. Deploying recapitalization bonds is a good idea as it will front-load capital injections while staggering the attendant fiscal implications for a period of time. So if anybody was worried about whether the RBI would see this as, going away from the fiscal consolidation roadmap, they do not seem to be seeing it in that light. They are, of course, seeing the more immediate benefits, which will accrue to banks as a result of this recapitalization plan. They go on to say, and this is the governor's statement himself, he says, as such, the recapitalization bonds will be liquidity neutral for the government, except for the interest expense that will contribute to the annual fiscal deficit number. Arvind Subramaniam has said that number will be around 8,000 to 9,000 crore per annum. The RBI governor goes on to say that this will involve the participation of private shareholders of public sector banks by requiring that parts of the capital needs be met by market funding. Okay, so they're saying that, government will do its bit, but then, of course, there will be some market funding for banks as well. And they finally say that last but not the least, it will allow for a calibrated approach whereby banks that have better addressed their balance sheet issues are in a position to use fresh capital injections for immediate credit creation. And that can be given priority while others shape up to a similar position. This provides a good way of bringing some market discipline to a public sector recapitalization program compared with other past recapitalization programs. So if I just read into those lines, they haven't specifically said it, but the RBI seems to believe that this recapitalization program will be structured in a way that perhaps the banks that have already cleaned up their balance sheets will get the capital up front, and the ones that are still heavily burdened by bad loans will be required to clean up their bad loans and then get additional growth capital. They seem to be hinting at some sort of structure like that. They go on to say that the reason this was absolutely critical is because financial sector policies need to support growth while maintaining financial stability. So again, reiterating a point that the RBI has made for some time now, that the fixing of bank balance sheets and fixing of the banking sector's health will be crucial in reviving growth. Whether it actually leads to sort of credit demand picking up or not, we will see once this particular problem has been fixed. But essentially, a statement welcoming, a statement saying that they support the structure of this recapitalization program, whereby recapitalization bonds will be used up front. And they also go on to suggest that it may be structured in a way that the healthier banks get the capital first so that they can get credit flow going. The other banks will be given capital in dribs and drabs so that they can first clean up their balance sheet and then go on and support lending as well.
Thanks for that, Ira. Thanks for breaking that down for us. And moving on to the other big story that we have for you, Reliance Communications has decided to shut down its wireless business. The beleaguered telecom operator will transfer some of its high-value customers to its enterprise business. Sajid Mangat joins in with the details. Sajid, it can't get any tougher for the Anil Ambani Group company right now.
That's right. It's going to be shutters down for the wireless 2G business of Reliance Communication. Now, that business totally, 2G wireless business has nearly 40 million customers, and that business will be shut down as on November 30th, 2017. What we understand is that as part of the entire restructuring which has been done, or contraction of business which has been done, undertaken by Reliance Communication, the ILD voice business, the consumer broadband, and and the dongle business, which is the 4G dongle for postpaid customers. These three would be merged with the enterprise business, and the remaining business, which is a 2G voice business primarily, will be shut down in 30 days time. The company attributes failure of its merger with Acell as one of the reasons, and these tougher conditions which are there in the market, especially with voice now going free. The business is not viable and not sustainable, and that's one of the reasons why they have to move towards shutting down this business. So it's going to be tough few days, because it comes only one day after Reliance Communications decided not to renew its DTH license, which was supposed to expire on November 21st. So it's coming out of DTH business and is now going to shut down the wireless 2G business. Alex.
Absolutely, Sajid. Now, thanks so much for that. You can stay tuned to BloombergQuint for a lot more. Do log on to the website for updates on those two stories. But now it's over to Darshan Mehta for Hot Money.
Thank you, Alex. Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is a show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Joining us on the show today is Ashwin Agarwal of Newberry PMS, and he believes that the markets are trading above its fair value. Samir Kalra of Target Investing says trade the dips and invest in the fall. And Amit Mantri of 2.2 Capital says the markets are quite rich, especially the mid-caps and the small caps currently. Today on Hot Money, we will discuss stocks like Asian Paints, Jubilant FoodWorks, Hero MotoCorp and Infosys, so all the large companies. First, let's move to the big one, and that is Asian Paints. The company came out with numbers which were in line with estimates, but the volume growth was rather strong for the company. What should one do with the stock now since the numbers are out? Let's ask our guest. I'll start with you, Amit. What's your view on Asian Paints? Do you think it's a bullish call, it's a bearish call? What do you think?
So I'm quite bearish on Asian Paints, and it's largely because of the valuations that it's trading at. LTM valuations are close to 60 times. So what the market is expecting is that they will be generating close to 20% earnings growth over the next 20 years. Now, if you look at the last 15-20 years performance of Asian Paints, even in that period, they've been generating earnings growth of 21%. So from this size to continue to generate the same pace of growth over the next couple of decades, it seems quite rich. Especially the fact that now market share gains is not really likelihood. Over the last 15 years, we have seen market share significantly expanding for Asian Paints, growing from 38% to now almost 54-55%. But now market share gains is not a really likelihood for Asian Paints, and therefore strong earnings growth from here is probably unlikely, and the valuations just don't seem to account for that.
The management gave a very strong commentary for the second half. They believe growth will come in. And secondly, post GST, there will be a lot of move from the unorganized to the organized player, which will benefit players like Asian Paints. So Paints is largely very organized, but still there will be that traction. Despite that, you believe that Asian Paints won't be able to sustain these levels?
Yes, it won't be able to sustain purely because of the high market share that they're already sitting on. So if there is even shift from the unorganized to unorganized, and now it's no longer, the unorganized is no longer such a very large market as it used to be 2 decades back. So much of the gains in terms of market share for Asian Paints are already behind. Okay. And if you look at whatever happening over the last 5-6 years also, the earnings growth has been much lower than what was the history of the company. So yes, GST and all will be positive for it, but at 60 times trailing earnings multiple, it's pretty much accounted for in the price.
Okay. Samir, I'll come to you. Amit does believe that valuations are very, very expensive. Yeah. Do you share a similar view on Asian Paints?
I'm actually contradictory. I'm very bullish on the stock, given 2 reasons. One is, if you see past 3-4 years, and especially the last 1 year, the demonetization, the GST have led to a destocking. And that kind has led to a reduction in pricing power, which they control over the market. So right now, whatever the growth is coming out on volumes. So since March till date, they have only done a 5% increase in prices, because they want to see the demand grow before they take the hike of the prices. Now, when I think right now the dealers are with the inventory of the pre-GST era, so now they might increase in November to December. That might be a 3 to 4% increase. And see, last 15 to 20 years have been more of a volume game for them. And paint industry is one where the capex doesn't come up too frequently. But when it comes, it changes the market share. So now, where the Asian Paints is planning certain amount of capex to be involved, there will be another game which beats others before that, because it's about the reach eventually. And Asian Paints has the largest reach as compared to any other paint game.
Okay, so that one thumbs up and one thumbs down. I'll come to you, Ashwin. Which side are you on?
So I completely agree with what Amit has to say. So basically, it's a classic case of a really good company in a oligopoly industry, FMCG, like non-cyclical. But unfortunately, it's priced to a point where if you're a long-term investor, you can expect 10 to 12% returns. As he said, the market's pricing in a 20% CAGR. So as like a back of the envelope calculation, you should try and think that the earnings should be 5x 10 years from now. Like the PE should be 5x the market cap 10 years from now as a back of the envelope. So if you do that for Asian Paints, you see that a 20-25% CAGR has been baked into the price.
But if you're talking about, you know, housing for all and all,
these are all
that
buzzwords,
system.
GST, demonetization.
See,
I could say, what if a foreign paint company came in, broke down the pricing, so the paint industry works on 10% margins. What if I started selling my paint at cheaper?
See, eventually it's about the volume game, right? Any manufacturing company survives on the volume game.
Say I have a lot of capital to burn, I just want to grab market share.
See, then we are
from
taking
Asian.
a hypothetical situations which are
But you're
not
saying
there.
you're saying housing for all, but you're assuming that people are going to keep buying Asian paints.
See, that was
like
the growth.
Paint's a commodity, like, I mean...
No, it's not. Now it's not. Now it's becoming a premiumization, especially in the urban dealers.
No, but you believe what Amit said, that, you know, on such a large base, initially it was possible to grow at 20%, but on such a large base, is it possible for Asian Paints
if it grows 20%, the owner of the equity at this price would earn a 14% return, like.
But that's on a large cap, right? A 13-14% consistency on a large cap.
Sure, it is a
very
great
big
company,
number.
yeah, but
so I can own more of it rather than having something else where the earnings are
I mean,
more
I would
volatile.
say if your target return is 12%.
Because I go for consistency.
Yeah, it's a consistent 12% at this price, but say if you wait and if the market gets bearish or for whatever reason the entire market cracks, you can get the same
If I were to just add, you know, right
Yeah.
now Asian Paints is getting a 60 times PE. This is a fantastic business. Everyone agrees with that logic. But if you look at just 5 years back, 2011, 2010, this company used to trade at 25-30 times PE. Now, there is no reason to believe that over the next 5 years, there will be periods when this company will again be trading at those kind of multiples.
See,
so so when you consider that fact that eventually multiples will come back to what they were historically there.
See,
so
my
then
part
it's
is
difficult to generate even a 10-12%.
Okay, I think it's time to move to the next stock. I think a big discussion, but it's a two thumbs down and one thumbs up coming in for Asian Paints. Let's move on to the next one, and that is Jubilant FoodWorks. The stock is trading at a 52-week high currently. Our valuation sustainable. It's trading at 64 times. That is also on a forward basis. I'll come to you, Amit. Jubilant FoodWorks, bearish, bullish?
So Jubilant FoodWorks, I'm much more bearish than say even an Asian Paints, purely because Jubilant is a business which is now getting structurally challenged. There is high competition which has emerged over the last 2-3 years. It's come from food delivery companies, the likes of Swiggy, Zomato, which has democratized food delivery. And then there's also the other pizza options, for example, which did not exist till a few years back, be it from the foreign brands, Sbarro, Pizza Express, or even to the desi startups, the likes of Fasos, Boxate, which have all now pizza options. So, for example, Fasos has Oven Story, Boxate has Mozo Pizza. These are all very small right now, but this is all incremental competition. And when again you look at valuations, it assumes that this company is not going to have even just 9-10% SSG, but 15-20% SSG over the next 2-3 years. I'm not sure that estimate is really justified. Even the management does not believe that it's in such a rosy scenario, because you're seeing Dunkin' Donuts has not performed that well. They're shutting down stores. Eventually, I believe Dunkin' Donuts will have to be completely shut down. Okay. Even Jubilant FoodWorks, they're not expanding at the pace that they used to expand earlier. So now growth opportunities for Jubilant FoodWorks are not that great. So yes, there will be margin expansion because they're shutting down the loss-making Dunkin' Donuts stores and some loss-making Jubilant FoodWorks. But the current multiple does not require just margin expansion, it requires much higher growth.
Do you agree, Ashwin, in terms of valuation?
I think, yeah, I completely agree word to word. So I would say Jubilant FoodWorks' main competitive advantage when it started was the delivery model. Like they had a delivery thing in place where they could deliver it to you really fast. So they got a lot of orders. Now once Zomato came in, Swiggy came in, people have a lot of options. So one is that on the demand side. Two, I mean, you could look at it as an umbrella company that gets all these foreign companies out to India. So the second bet was Dunkin', which hasn't scaled up. Similarly to Starbucks. So maybe like the coffee model is not that great in India because it's a hot weather country, probably, if I had to take a guess. But yeah, and the third, the valuations are high. It's a more heavy capex business. So the
But why do
flows.
FIs love this stock?
I think that's the only reason why it's held up, because there's some mischief going on. Because honestly, this is not like some crazy analysis.
Just to give you a context, Domino's globally, be it in Australia, the US, franchise is doing phenomenally well. And
the parent commentary that came in from Domino's US was very positive for the Indian
so if you look at the multiples that the Domino's Australia or the Domino's, it's also trading at phenomenal multiples. It's very high, rich multiples. So someone who's sitting in the US, he's looking at, okay, this is Domino's India is the second largest market for Domino's. So if I believe that 20 years, 10 years down the line, it's going to be a fantastic, going to do as well as it did in the US and Australia, maybe I want to take a bet on it. But of course, again, should they be doing it at current valuations where there's a lot of optimism priced in? I'm not sure.
I think the Domino's parent probably trades cheaper than this, like as an absolute level. But here's the thing with Jubilant. Say if it gets, the only risk to the bearish forecast is, say if they get a third, if they sign another deal, just how they signed Dunkin', which really takes off. But apart from that, as the way it stands, I think there are better things to invest in on others.
Samir, any view? We have a 2 thumbs down again on...
I have a neutral with a little bullish chance. I'll tell you why. Because right now, whatever presence they have, around 30 to 35% presence is a monopoly. When I say that is the cities they are in, if you exclude the top tier ones, there are no other options. So whereas Amit is mentioning, there are options, that's limited to top tier 1 cities. So over there, the whole point is, right now they've introduced a everyday offer. Earlier they used to do a discounting part, which wasn't that attractive for them. So the SSG, which came 6.5% last quarter, was in a big way contributed to this everyday offer, as management even said. In the second part, where I'm a little concerned on, is the Dunkin' part. The only problem in the Dunkin' part is not the levels they do the capex on or anything else. They have an agreement with Domino's on a global level and on the Indian level that they'll not do any delivery business with any other franchisee. So if somewhere, I don't know about the tenure of it or that kind of thing, if that clicks out tomorrow or maybe next 1 year, then it'll be a big trigger for the capex hungry Dunkin'.
Okay, that's the view that's coming in on Dunkin' Donuts, on Jubilant FoodWorks. Sorry, Amit and Ashwin are negative on it. Samir does believe that he's neutral, but he does believe there is a stance of a slight bullish view that's coming in on the counter. Let's move on to the next stock, and that is one of the cheapest two-wheeler stocks that we have, but the largest two-wheeler stock in the company, Hero MotoCorp. Very, very strong sales coming in Dhanteras. Demand recovery is there. The valuations, it's one of the cheapest stock. Strong return ratios. What should one do in it? I'll come to you first, Ashwin. Hero Moto, do you have any view?
So yeah, I mean, I'm neutral. If you analyze the industry, it's a very high ROE business. So it's a great business because there's not a lot of capex and relatively the turnaround's really fast. One of the risks is that as India becomes a higher income per capita income country, the relative demand of two-wheelers will decline. So the growth rate of the past shouldn't be, you shouldn't forecast it to be the same in the future. That being said, it has pole position in the 100cc or 120cc bikes, which are typically lower margin as compared to many of the peers. But then they're also there in scooters. I would say the real growth to them would come if they can build an international operation the way Bajaj and Honda, all these companies sell globally. So if Hero can mimic that, that's where the growth's going to come from. But even if the growth doesn't come from, I mean, they make around 4,000 crores. It could be a really high payout ratio stock. They could pay out easily 80% of their earnings. So I would say I'm neutral, but I would say for the stock to perform really well, I think the key is the international operations.
Samir, do you agree with...
I'm also neutral, but a little bearish on the stock. not because of the valuations or anything. It's just that if you see the dynamics in 2012, they had around 4,700 touch points. When I talk about touch points, there are authorized dealers, there are sub-dealers and all that. Now they have around 6,000. So in 2012, they used to sell 1,325 motorcycles per that touch point. Now it's 1,250. So somehow there is some kind of a disconnect between that kind. So either they need a certain amount of capex to increase that number, because there seems to be a supply constraint in this number. So they are more dependent on the international operations, which are another uncertain part of it. Second is the point which is talking about Bajaj Auto. They are getting into manufacturing. Hero Honda is getting into the manufacturing. So the payback periods are longer in the international operations. So that hurts your cash which you have on the books. So somewhere I see a little bearish thing coming up, but I'll still keep a neutral view.
Okay, do you agree with them, or do you have a different view on Hero?
So I'm slightly positive, but I don't really have anything significant to disagree with both Ashwin and Samir. Yes, the growth in terms of volumes that we have seen in the past should not be replicated in the future, as Ashwin was saying. But this is a business which does not require a lot of growth to justify its valuations. It's trading at LTM PE of 22 times, and when you consider the fact that the last 12 months had the demonetization impact, it had the BS4 losses into the earnings, then it's really much lower in terms of the LTM valuations that you're actually paying for it. And all it needs to do is have even high single digit or low double digit kind of volume growths, and probably the valuation would be justified. The thing that I feel positive about is this company was suffering on the volume growth. It was losing market share because rural was not doing that great. And rural is where the largest number of motorcycles are sold. Urban has now become a scooter driven market where Hero is quite weak. Rural even now is largely a motorcycle driven market, and which had not seen a large volume pickup over the last 3-4 years. Now I think we are seeing it. Even last year in FY17 also, in the first half, we had started seeing that pickup. If you see last year's first half volume numbers of Hero, they were quite strong actually. But demonetization came in, and then they started seeing a volume decline. Now again, I think that pickup is happening. There's a lot of pent up demand on the rural side. So if there is a rural recovery on two-wheeler volumes, Hero would probably be the biggest
What about
beneficiary.
margins? Because Hero trades, the margins of EBITDA margins of Hero are much lower than what a Bajaj does or what an Eicher does. So is there something that is that Hero is missing, that they're not able to get their margins right?
No, so both Eicher and Bajaj operate on the premium side of the two-wheeler market, and Hero operates.
Sorry, I'm cutting.
And sorry.
Even their scooters, which they are making, is a lower margin product for them.
So I agree. So the margins, we should not expect Hero to generate the kind of margins that Bajaj or Eicher is making. They have much higher pricing power. For Hero, it's largely a volume game. So they have in bikes almost a 60% market share. The question is, will that come down significantly over the next few years?
So it's like what you're saying, it's like a DMart, to maintain the margins but grow the volume.
Yes.
Okay. So that's the view that's coming in on Hero MotoCorp. Amit is rather bullish on Hero MotoCorp, but our other two guests don't share the exact bullish view on the counter. And the last stock that we'll talk about is the stock that came out with numbers yesterday, Infosys. The counter has managed to recover from the lows of the day. Despite the ADR being down 2%, the counter opened in the negative, has managed to recover. Now, the earnings were not bad for Infosys, but the guidance cut that has come in. So which side of the table should you be on? Do you think that there is a potential weakness that is there, or potential trouble with the internal corporate issues that are going on in Infosys, or do you think that they have been able to get their act right? Let's ask our guest. I'll start with you, Samir. Infosys view?
Yeah, I'm bullish on Infosys. See, the numbers were better than expected for sure. The other thing which I'm looking at is the net employee added came slightly negative, better than the last quarter. So there is some kind of a stabilization over there. The capacity utilization of the employees was highest in past 2-3 years now. Now the only point which is left is the corporate governance. That somewhere is out of the situation, which investors I think are sorting out at the back of it. But again, it's more of a next 2 quarters will be much more clearer on the governance part of it.
Namit, do you agree on Infosys? Do you
Yeah.
share a bullish view like him?
Yeah, so even we share a positive view on Infosys, and it's largely because while guidance has been reduced, so far the earnings are not that terrible. So they are being able to grow earnings even now. Infosys in some ways will end up being a representative, TCS Infosys will end up representative of how the IT industry does in India. There's a lot of focus on governance, and the reason probably is that Infosys will do much inferior than the rest of the IT industry. We don't think that it's such a big deal. Yes, there will be some noise if promoters come back and do more, try to change the board again. But that's really what captures the imagination of the investors, but it doesn't really impact the business significantly. If they are able to maintain even the current revenue guidance that then the valuations are quite attractive. It's at 14.5 times trailing earnings. It's a phenomenal cash generating business. The payouts are now there's much more clarity. There is a buyback, then there's 70% payout of the free cash flow. So on that front, a lot of positives have already happened, and the valuations don't factor in the current EU guidance also, I believe.
Okay, what do you make of it, Ashwin?
So I want to make a disclosure. I'm invested in Infosys, and that obviously means that I'm bullish on it. I think it's price what you pay, value is what you get. So while Asian Paints is a great business and it's trading at 50 times, I think Infosys is also a great business. It just hasn't grown for the last 1 year. Basically, there's a technological reset. So what happens is whenever there's a new tech, earlier the more higher skilled people like an Accenture and IBM will gain market share because they have those core competencies. But then once the industry size becomes big enough, the Indian IT professionals get skilled in it. So there's a lag with all this happens. The competitive advantage of Indian IT is it's cheaper, basically. And that's, till that holds, the Indian IT industry will grow. It's just going to be, I think it might stagnate for a year or two because till the transfer happens, till this transition happens. But you have so much comfort on the valuation. They have 40,000 crores in cash, which is 20% of the market cap, out of which they're giving out 20,000 crores within the next month. So if you're a retail guy, you should definitely participate in the buyback. That's a good arbitrage if you hold below 2 lakhs. So yeah, I mean, over 1-2 years, I think there's barely any risk, and I think there's a decent enough reward. So.
Okay, so that's the consensus bullish view that's coming in on Infosys. Before we wrap, here's a quick recap of all the guest view on the stocks that we've covered till now. Okay, Amit, Ashwin, Samir, thank you so much for joining us on the show. With that, it's a wrap on today's Hot Money. Thanks for watching BloombergQuint.